The markets broke out to a new 52-week and all-time high, for that matter, in the S&P 500. We're not quite there in some of the other indexes, but a nice, good bullish move in stocks. Not something that should be completely surprising if you've been watching these videos over the last few weeks, especially since the end of May, when the chorus seemed to be really bearish on the markets, and we had been looking for a move back to the upside over the last couple of weeks now that we've gotten. So now we're going to break down what we expect to see going forward from here, as we always do, using those same technical indicators to see whether or not we are really overbought at this point, and if we have more to go. So we're going to take a look at a stock that's giving us a really nice, good bullish pattern in an area that's been relatively weak that has been gaining during this rally. So let's go ahead and get started. Today is Thursday, June the 20th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500, as always, with the Market Forecast Indicator, and look at the intermediate line now up at the 86th percentile. Again, back here on May 31st, when it dropped below the 10th percentile, we finally got the cluster we talked about. It was actually right on this day right there. We got the cluster. We talked about the potential for the intermediate line to make a run right up to the highest part of the chart. Similar to this move, and lo and behold, after one down day on June 1st, or June 3rd actually, because that was a Friday into Monday, we've been up ever since. In fact, from that point, from that Friday Market Outlook video where we talked about that bullish possibility there, we're actually up about 7.5%, as you can see. So the markets are kind of following through with expectations. The near-term line is in the upper reversal zone. That's kind of where it needed to be after getting up above 50. Remember, the idea is it needs to get above 50 and stay above 50 for 7 to 12 days. We are now in day 5 of the current near-term run. And the other aspect of that is that we needed to get above 80. And it's clearly done that. The momentum line is kind of oscillating, very small ranges, but it's kind of oscillating around the midpoint. That doesn't matter. What matters, any reading we get from the momentum line will be any small dip below 20 would be a bullish intermediate confirmation signal, and any large dip below the 5th percentile would be the signal the possibility of a trend change. Barring that, right now, nothing else really matters with the momentum line. You see we have dark green shading and a green line now. Moving average is heading up. There is a little bit of a lower shadow developing. That's not as bearish as a long upper shadow is, but it is some. It is, there is some short-term bearish potential because of that. Of course, that's not the only indicator we look at, so we'll take a look at more here. But that's just something to keep an eye on. Other than that, you can see we got the high of the 52-week high here today, 29.58. So we broke up to a new all-time high. In fact, we closed at a new all-time closing high on the S&P 500 as it continues to push through and getting up to close to that 3,000 level. So breaking through. Remember, there wasn't very much resistance up here. It was mostly down here. Once we cleared that resistance here, then you can see how easy it was to make the rest of this run. So, that's why that volume profile. When we look at the volume profile, here we go. Nope, that's not it. Volume profiles in the Bollinger Bands, and look at SP. Well, for that matter, we can look at ES as well. Once we busted through here, which was here, let's get rid of the cone. The cone is kind of scrunching my chart for us. So we'll get rid of that probability of expiring cone. And then just for a second here, let's get rid of, we can get rid of the retracement lines now. You can see once we got through, once we got through the point of control here, then it was up, really big. And of course, we hit some resistance at the top of the value area here, would be at 29.26. And then yesterday clearing us right on through that level of 29.26, and you can see very little volume in the current area, so not as nearly as much resistance. So getting above that value area for the S&P, it's not too often that we do. I mean, this entire move, we were, below the value area. In fact, you could say probably right around here, April 1st of 2019, to kind of give you an idea of what things look like. I always hit the wrong buttons. Back on April 1st of 2019, we'll go back to April the 2nd to get a full year of 2018 to see what that volume profile is. We were rising up during that whole time. We'll go to daily chart here, and this would be 2018, of course. And let's hit OK. There we go. Finally got it up here, and you can see there we finally broke through the value area at that point of April 1st of 2019. So now we go back to what it looks like right now. And you can see there's April 1st, and we continue to push up higher before we met out some resistance. So, or short-term peaks, and we rolled over. So now we are in the mode of pushing up higher above the value area, an opportunity to be bullish here on the S&P 500. If you take a look, at the other major indexes, remember the S&P is at all-time highs. The Dow is getting there, not quite, but it's getting closer. So we got a couple hundred points to make its way. But you notice same pattern, the intermediate posture, the near-term line. There's a big-time near-term divergence setting up here. Of course, we'll see if we hold up that 7 to 12 days, but that would target a low point back down into this area if that divergence plays out. Potential divergence plays out. Same thing happening on the NASDAQ composite. And when you look at the Russell 2000, pretty much same thing happening there. The Russell 2000 still not giving us the dark green line with the dark green shading. We're still falling slightly on the moving average. In fact, if you notice, it's the last one. The NASDAQ's finally turned up, the Dow's turned up, and then now the S&P 500 also showing the same near-term divergence potential. They are also with the positive combination of dark green shading and the green line. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen, then hit that red subscribe button that pops out. You can also hit that red subscribe button right down below the video. Then hit that bell right next to the subscribe button. That will notify you when these videos are posted. Also, hit the thumbs up icon down there. That tells me, number one, you got something out of the video today. And number two, you want us to do the video again tomorrow. It's a quick, easy way to give us feedback. We check those every video to see what you're thinking. So take a quick second. You can do right now while you're watching the video. Comment down below on anything that stood out to you from the video. What did you get out of it? Join our daily market outlook email list. There's a link that's popping out right up there in the top right corner of your screen. Easy way to subscribe there. Follow me on Twitter for more content in between videos from day to day, and join our Market Outlook community that we've created on Facebook. Also, we want to invite you to subscribe to our Market Scholars website. You can, if you're watching our video here on our blog, you can go right above to the top right where it says Join Market Scholars. Click on this image. It will take you to a page where you can subscribe for free. Again, by doing so, you can participate in our Market Outlook forums, as well as be able to watch the video. And we also want you to engage with us on social media with our Market Outlook tweets and posts. We make it really easy by putting them here. Just click this heart. It opens up a new window. You can like the tweet and then click that image, and it takes you to your Facebook page. You can like tonight's Market Outlook's post. Again, the more you engage with us on social media, the more those platforms will continue to push you our stuff in your timeline. So they don't do that for all of the stuff that you follow because they can't. But they will for the stuff that you engage with the most. So we try to make it as easy as possible for you to engage with us here. All right, so back to the charts, you can see again, how bullish we are, even on the weekly chart, where the momentum is climbing. Remember, the momentum already is relatively high, so we're not looking for like huge gains from like this point going forward, just because this, like I said, the momentum is now as high as it is, way back in here. In fact, if you take a look at the PPO, which basically is the relative MACD, if you look at on a longer time frame, it relates it to just how bullish we are. So right now, it's like the MACD relative to a certain level. And if you see, we're at 2.86 right now. Just to show you how bullish that is in terms of momentum. This whole period right here was above that level, and then we started to lose it once we crossed it. This whole period was above that level. So when you're saying, again, you can see a lot of months here and a lot of months there. So getting above this level has led to pretty long-term bullish runs in the past. So as bullish as it seems, whenever I pull up the MACD itself, MACD histogram, or 2 lines here, and then do the 1040. So as bullish as it seems here, and we'll just show the MACD by itself. It's not really at that bullish. See, if you look at it here, at 75 essentially is the current level of the MACD itself, and which is an absolute value, not a relative value like this. You can see not nearly as bullish, right? That wasn't nearly as bullish of a time frame. These levels over here, not nearly this. You see how the difference is, not nearly as bullish. And of course, all that period, this period a little bit more bullish. This was about the same because we're at the current. We're pretty similar to those prices. But you can kind of get an idea that we actually, have been pretty bullish at the. We have a lot of positive momentum to go on the PPO when you look at it on a relative basis to all the way back here versus on the absolute basis, because the price getting higher impacts the absolute number that's down there. So it seems like we're really overvalued here in terms of momentum, but the reality is we're not. And in the past, when we've crossed above this level, we've been bullish for months going forward from here. So on this chart. Now let's take a look at the Hakinyashi candles here, and you can see again we have a really good bullish candle here this week, and again we expect that we expect a 1 to 3 month intermediate return. So that means about 4 to 13 weeks of these candles to expect going forward. So we've got candle number 2. We looked for a transition candle, we got it. After the transition candle, we looked for a bullish candle, we got it, and we're continuing forward with that expectation. And now let's take a look at the 3 green arrow chart for the S&P 500. And you can see we got 3 green arrows and a green line because the moving average is finally turning up. So very, very bullish pattern in that regard, with both lines rising above the 50-day moving average. The MACD and stochastics both rising to their high levels, at which point, after the surge to high levels, then it slows down, but it continues to trend higher as it slows down, and we're still kind of in that initial positive surge that you get that sets the high point, and then we start diverging our way back towards here. You can see the kind of the pace that we got going on here. We're kind of following this green line towards June expiration. At that point, we'd expect it's going to slow down towards that July expiration. All right, now let's take a look at the intraday action. And a lot of you probably follow me on Twitter. You notice when we gapped up here, in fact, you can see right about, whenever that was, I tweeted this out. This is what the chart looked like. We had just barely started. We had this big gap up to the upside. And as I mentioned in my tweet, I'm not a big fan unless it's a breakaway gap here, or a runaway gap that usually occurs right at the beginning of a trend, or a breakaway gap like this one where you're breaking through a certain area with a lot of volume. In this case, it was like that 292.5 area. You had the increase in volume after really flat. So those two gaps I mentioned before, they really, they don't tend to get filled. But just about every other gap, as you can see, does. And so we were really neither starting a new bullish trend because it was an upside gap, nor were we breaking through a significant level, right? We had already done that over here. And so the reality was that's more likely going to be a common gap. That is a gap that gets filled. And that's kind of what I mentioned in that original tweet here this morning. right there. And then as you can see, I followed up that tweet a little bit later as we started to fill in the gap and kind of mentioned, that important level of 29.50. And of course, as we saw by the end of the day, we filled in completely that gap down to almost 29.30 before finishing at the high of the day. And my thought was, don't chase early pre-market light volume moves and get in up here, knowing that you could probably get in, especially on these bigger gaps, at a much better price on trades that you're looking at. So that's what happened. Ultimately, we finished at the high of the day, so that's bullish. And we did get a higher high and a higher low. And that higher low was, pretty much at the top of yesterday's high. And you can see the range here now is up to 23 points. We're not quite at 10% here, but that's a pretty strong number for a range to the upside coming off of a bullish move. So keep that in mind in terms of long-term potential here. As we saw on that one chart with the green lines, there's a really good likelihood that we're going to really start to flatten out these gains and grind our way more, especially when you see the volatility chart. Well, first of all, let's take a look at the volume and range for today. And you can see the volume really picked up with a 1.5 times the average volume. And of course, the range today includes the gap. So we closed at 293.06. The low was 293.13. So we had about 0.07 of a point of a gap. We almost completely filled in the gap, and then the range of 318. So we're looking at about 3.25 points range with a yearly high. If you look at that on average here, you can see the volume number was 1.5 times the average. Let me get back, see what that was again. I didn't see that number. 116.5 million. So now let's put that number into context. 116.5 is right up here. That's pretty bullish, and that will bring this line up. But again, that's because we're going to all-time highs. I would not expect the volume to stay there, and if it does, I would be bearish. Volume can stay low and can get low and stay low for a long time, and that's what I would expect it to do. The range 3.25 points, just barely above the average, right there, and of course breaking below the 1% mark here, because 3.5 points is more than 1%. So as we start getting ranges of 29 points or less, then you'll get this breaking below the 1% level, which is, again, that kind of train has left the station type of signal. And finally, the volatility index broke below here this week 15. It's gotten to 14.5. We have not held or broke below and held that 90% break. That's your other signal that the train has left the station. Because as you see in prior instances, once you get below, we have to go a couple years back now, but once you get below 90%, and once you go up above and you get below and you kind of make that little run, the next intermediate low point, then you get below 90%, you stay down there. And you can see we've had our surge, we came down, we've made our bounce back up, and now we would expect if and when we do close, similar to over here, May and June of last year, once we do break down, then we'll trade like July, August, and September of last year down below that 90% mark in the bullish territory. So to summarize, the market does look like it's, we got all-time highs. It looks like it might be overextended. But in an absolute sense, but in a relative sense, the market's not very bullish at all, and there are still signs that while the train is at the exit point, it hasn't yet left the station. So, and other signs that show that when we're as bullish as we are now, there's been weeks and months of bullishness that's come after. So we might not be as near-term oversold as we think we are. We might have at least a few more days here before we get any kind of short near-term pullback, whether that's short in amount of time, 1 to 3 days, or the extent of the pullback, 23% Fibonacci retracement or less, it seems like lately, or both. And then we get a new near-term run and continue the multi-month intermediate run that we're expecting here. So it doesn't, it does, as much as people might say, oh, we went so far up so fast and now we're just going to drop like a rock. That's not what some of these technical indicators are showing us, the ones that we look at day in and day out. So what do you think? Do you agree with that assessment or disagree? I want to hear from you. So to vote, click that link right there that's popping out. It opens up a poll, and then vote with either agree or disagree. If you click disagree, I would love to hear why. Either you're more bullish or not as bullish as we came out with in today's video. Show me, or if you'd like, show what you're seeing down in the comment section below that would suggest otherwise. All right, now let's talk about what's driving the price action. And of course, one of the biggest movers, at least in the last couple of days. Here, let's just go to the last 2 days. This would be June and then the 19th into today. So we'll go back to the 20th there in 10 minutes. You can see the dollar dropping as much as it has. The UUP down 1%, which is a really big move for UUP. Agricultural commodities also a little bit down. They've been rallying so much. You can see long-term bonds are actually up, which means yields continued lower. Small cap stocks lag behind large cap stocks, so this isn't a full risk on move. But look at international stocks, which have been lagging. They really benefit from the falling dollar. Gold, of course, also has really broken out, and crude oil. So let's take a look at some of these charts for some of these different asset classes. And of course, we've been talking about the bearish potential for the dollar for a while. It got light green shading and the green line, not the dark green shading. And now we're back to red line, dark pink shading. A pretty bearish 2 days for the dollar, coming up to this moving average and then breaking its way back down with the intermediate line falling again. Of course, breaking through, this 96 level would get us probably down into, towards 94 as a potential. So, forming a lower high, this near-term high is a lower high. You can see how bearish the dollar is. And of course, that's the most direct impact this has on gold. But if you see that long upper shadow on gold that we're getting, that can definitely be a bearish sign, at least in the short term, for gold to produce more of a pullback. So look for gold to pull back a little bit here, especially if you're trading in those minor spaces. Look at crude oil, and crude oil has been kind of broke out above that 55 level. We talked about 55 being the target for the divergence. Well, not only did we get there in the last couple of days, but today breaking through that level. So very significant bullish pattern. Of course, you don't have that bullish combination yet of dark green shading and dark green and a dark green line, but we're getting closer and closer to that. So that's going to be a bullish pattern for crude oil. And then finally, let's take a look at bond yields. And you can see again down to 2%, getting below 2% today. Extremely low yields for bonds. You can see again all the clusters. It's so rare to get this many weekly clusters in a row, but we're going on number 6 in a row here. And of course, when you look at the monthly chart, we're not quite to a cluster yet, but those short-term sentiment lines are both down the levels that we haven't seen before in the history of this particular chart. TNX. So at least since the bull market low point in 2009, at least for stocks, we haven't seen yields drop, in the short term as much as they've had, according to both the blue line and the red line. In fact, the only other time that's comparable, and we did get to about those same levels, is right here. That was July of 2010. We continued lower, and we were obviously well above 2%. We were closer then to 3%, but we continued lower to 2.5% another month later, with another month of really low levels there before we got the turn up higher and we made a run on crude oil, but in bonds, but we didn't change the trend, and I do expect a run like this to come out of here. And also, I don't expect the trend to change because of it. I think we'll end up forming a new low, probably around this 2.5% level, before we roll over again and continue the legs to the downside. If you take a look at the different foreign markets and how they're performing, you can see they're all green now. India and UK are still kind of lagging. The intermediate line's falling. That long, this little pullback that India's had, and you can see UK had pulled down below its moving average way down there, but has since bounced back up. But look at some of the breakouts we're getting in Russia and Canada and Brazil getting to 3-month highs, and Japan getting higher and higher. China breaking through. And potentially giving us, we don't have that dark green line yet. We don't have the dark green shading with this being above 50 and rising, but we're getting a lot closer. In fact, a lot of these, this has got that, France has got that combination of dark green line and dark green shading. Germany's not quite there yet. Italy will be getting closer. India is getting closer as well. Of course, Brazil and Canada now has that combination. Russia has had it for a while. And Korea is getting closer. So you can kind of see Japan's kind of roll over. You can see there's a shift in a lot of these major markets to new bullish trends that we haven't seen for a while. Of course, from a news perspective, the biggest news is this Philly Fed survey, which, like the Empire State Manufacturing, earlier in the week, the two biggest regional manufacturers, aside from the Chicago PMI, you can see how the number here dropped to 0.3 for the Philly Fed survey from being originally at 16.6. So that pink line dropped significantly lower. Remember, the ISM earlier this week also dropped to really low levels to minus 8.6 from 17.8. So both these lines went from strong readings last month to really weak readings this month. That's showing up in a still persistent negative economic surprise index. And it's also impacted rate hike odds. So you can see that now there is literally a 100% chance that we'll get a rate cut, in July. And then you notice now by the end of the year, we obviously have a 100% chance we'll get a rate cut by the end of the year, the 225, 250. Just a month ago was a 35% chance. It's gone all the way to 0. We have a 95% chance of getting 2 by the end of the year. But then we only have a 65% chance of getting a third one. So the odds aren't necessarily too high there. By next April, as I've shown you before, we have a 100% chance of 1. We have a 97% chance of 2. We have about an 80% chance of 3. So now we're pricing in a third rate hike now. And then after that, it really drops down. So looking like by between now and next April, and that could be September, December, it'd be July, and then we look for somewhere in these areas to get that second and then possibly third rate hike to next April, at least again according to the futures market. So from a sector standpoint, you can see again over the last couple of days when the dollar's been really weak, it's been the kind of biggest mover to the downside. You can see what the biggest sector moves were. Again, energy, industrials, materials. If you recall, we looked at that 200-day chart and we saw how staples and healthcare and all of these were the weakest performers, or were the strongest performers over the last 200 days. And there was chatter about how their strong relative performance is a sign of weakness for the markets, and we talked about how it's actually a sign of strength. For the market, at least potential strength going forward from here over the next 200 days. So, if I were to look at a crystal ball 200 days from now and see, what the past 200 days performance would look like up to that point, it probably wouldn't have staples and utilities and real estate being the best performers. It probably would have other areas that have been the weakest over this past 200 days, and that has been energy and industrials and materials. Now, if you notice, if I go back to June the 3rd, when we hit that low point and have since rallied up, you'll see the best performing asset class has been materials. And it really rallied up early and it's been kind of holding its gains. Some of these other discretionary technology, consumer discretionary, a couple cyclical sectors, have also outperformed. And then you see energy and industrials up there at 8+%, while the market itself is up almost 7.5%. And then your safe haven areas, your interest rate sensitive areas, at least aside from financials, which is interest rate sensitive on the other side, when rates are rising, all of these sectors are all underperforming right now, which is not surprising because they tend to outperform when the markets are bearish and they tend to underperform when the markets are bullish. The nice thing is that you can, as you can see here, that's still pretty decent gains, 5% gains. So they hold their value really well during underperformance periods or when bearish periods in the broad markets. And then while they don't have high betas and they don't outpace the markets going up, they still show pretty good enough gains that through the ups and the downs, they end up having better gains than some of these other sectors. So for our trade idea of the day, I want to take a look at a bullish trade here on CSX. CSX, you can see, has got the dark green shading. We have the intermediate line turning back up again above 50, so the dark green shading there. If you look at its moving average, it was 77.10 yesterday. It's at 77.13 today. So tomorrow it'll turn green. So we'll have the bullish combination of dark green line, dark green shading. If you look at the 3 green arrow chart for CSX, you'll also see 3 green arrows here. MACD already was green, so Stochastic's turning up today. You can see also almost a relative spike in volume. Not quite 1.5 times the average, but higher than we've had over the last couple of weeks in CSX. If you take a look at the Bollinger Bands, we are already above the value area, which is a positive sign in and of itself. And you can see we're kind of at we were at a volume node, and we opened up above that volume node and then traded further higher. So that's a good sign as well. Let's take a quick look at the DMI chart 2 for the same stock. And you can see we got the orange line was already below 20, and we crossed back up above 25 again. So a good solid DMI indicator for CSX as well. And then look at the long-term chart, and you see it's on a nice, good, solid upward trend. And you see from a longer-term perspective, putting that PPO in perspective there, we're not nearly as bullish as we can be. You can see if I were to put my horizontal line where we're at right now, here in the last couple of years, we've had weeks and having a higher, stronger positive momentum than we have. So, well, and going back over the last 10 years, you see other instances of that as well as we cross above this line. So you're not nearly as bullish. There's opportunity for some bullishness going forward from here. Didn't mention the other 3 green arrows here. The Stochastic's almost crossing above its moving average. MACD bouncing up off its moving average, already above 0. Stochastic's also above 50. And you see the 8 and the 17-day moving averages are crossing up above 30. So bullish patterns all around. Again, we can look at selling the 77.5 and buying the 75 call, getting us the credit that we need. Probably get filled in around 62 cents. 60 or 58 is what we need to get filled in on this trade. And then of course when you analyze this and let's reset these parameters and delete any oops, nope, I did not want to delete that simulated trade. So analyze that, and then we will set slices to break even. Let's get this one standard deviation by 720. You can see the 62% probability of success, and we'll set that slice onto the chart itself, and you see that we basically have to get below this low point that we're bouncing off of for us to end up taking what we'd hope to be a small loss. Around $62 is about as much as we're willing to give it. And of course, you can see again they get to a $62 loss, which is here's minus 50, so it'd be down in this area. You can see it'd be quite the move to the downside for us to get to that point. All right, well, that wraps us up for today. Now I want to hear from you. So use that link that's popping up there in the top right corner of your screen that takes you to our forums. Remember, you have to subscribe to our site, but you can do that for free, as I showed you earlier. But love to hear. Open up any new threads with any questions or comments you have about what we discussed in the video today, or anything we didn't discuss that pertains to the market posture. And then reply to anybody else's threads that you see there. And let's keep this conversation going here. As always, thank you very much for watching. Have a great rest of your evening here, and we'll see you all tomorrow. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on our video. Follow me on Twitter for more content between videos, and remember to join our community at marketscholars.com, as well as the one that we created on Facebook. Have a great one, everybody, and we'll see you all tomorrow.